In this video, we're going to simplify IRS Publication 550, Investment Income and Expenses. If you invest in stocks, bonds, mutual funds, or other securities, this publication explains how the IRS expects you to handle income, expenses, and capital gains on your tax return. By the end of this video, you'll understand what counts as investment income, what expenses you can deduct, how capital gains and losses work, and where all of it goes on your tax forms. So let's start with the basics. What actually counts as investment income? Investment income generally includes interest, dividends, annuities, royalties, and gains from selling investments. And interest income, this is what you earn from bank accounts, bonds, or loans that you've made. Most interest is taxable even if you physically don't receive it yet. For example, if it's credited to your account and you can withdraw it. Dividends, these are payments you get from owning stock. Some are qualified dividends, which are taxed at a lower long-term capital gains rate, while ordinary dividends are taxed at a regular income tax rate. Capital gain distributions, when a mutual fund or investment company sells assets and passes the profits to you, that's also investment income. Even if you earn this income from a foreign source, you still have to report it. Now let's talk about investment expenses. There are costs that you pay to manage or produce investment income, things like advisory fees, record keeping, or safe deposit box fees. Now, most of these used to be deductible as miscellaneous expenses, but since the Tax Cuts and Jobs Act, they're no longer deductible through 2025. However, investment interest expense, the interest that you pay when you borrow money to buy investments, such as margin interest, it is still deductible, but it has limits. Here's the rule. You can deduct investment interest only up to your net investment income. That means your total investment income minus investment expenses, but not the interest itself. If you have more interest expense than income, the extra can be carried forward to future years, and you calculate that using Form 4952. So selling investments, that's the next one. This is where capital gains and losses come in. When you sell a stock, bond, or other investments, you'll compare what you got for it, what you received, the sales proceeds, to your basis, which is generally what you paid for it plus any adjustments. If the sales price is higher, you have a capital gain. If it's lower, you have a capital loss. And then you have to consider how long you held it. If you held it less than a year, it's a short-term gain or loss, taxed like regular income. If it was more than a year, it's long-term and it's usually taxed at lower rates. Typically, you'll get a Form 1099-B from your broker listing each sale, and you'll use that to fill out Form 8949 and Schedule E on your tax return. So Form 8949 is the detail and it flows into Schedule D. If you sold multiple lots of the same stock, you can identify which shares you sold. For example, using the FIFO or the first in, first out method, or specific identification to manage your taxable gains. So if you bought the same stock in 21, 22, 23, 24, and your 2024 tax return, you're probably going to want to identify that you sold your Ford stock from 2021, not 2024, because you're going to get a better favorable tax rate. Couple examples of these forms. This is what a 1099-B looks like. You'll typically get a 1099-B from your broker listing each sale. Usually they summarize it in a form, in this IRS form, and then they'll usually, depending on how many items that you had, there could be several pages attached to it giving you the detail. Use this form to fill out Form 8949, and you have a Part 1 for short term and you have a Part 2 for long term on this form. And then your information on this form, it's kind of like a transaction log. It includes the details of what you sold, when you bought it, and the gain or loss on each sale. And Schedule D, here we go, got an example of that. Schedule D is a summary page that takes the detailed results from 8949 and combines them with other items like capital gain distributions from mutual funds that are reported on a Form 1099 div. Prior year loss carryovers show up on this, and any adjustments or special rules, installment sales, section 1202, stock, etc. If you sold multiple lots of the same stock, you can identify which shares you sold, for example, using the first in, first out or special identification method. So you can get the more favorable tax rate. So to recap, the quick summary of Publication 550, know what counts as investment income, track your investment expenses and interest, and understand how to calculate and report losses. And you can find the full publication on irs.gov.